Ladies and gentlemen, good day and welcome to Capacit'e Infraprojects Limited Q4 and FY23 conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Before we begin, a brief disclaimer. The presentation which Capacit'e Infraprojects has uploaded on the stock exchange and their website, including the discussions during this call, contains or may contain certain forward-looking statements concerning Capacit'e Infraprojects business prospects and profitability, which are subject to several risks and uncertainties, and the actual result could materially differ from those in such forward-looking statements. I now hand the conference over to Mr. Rohit Katyal, Executive Director and CFO. Thank you, and over to you, sir.
Good afternoon, everyone. On behalf of Capacit'e Infraprojects, I welcome everyone to the Q4 and FY23 earnings conference call of our company. Joining me on this call is Mr. Alok Mehrotra, Mr. Nishit Pujari, and our IR team. I hope everyone has had an opportunity to look at our results. The presentation and press release have been uploaded on the stock exchanges as well as our company's website. The performance of financial year 23 has been satisfying as we continue to accelerate profitable growth and build our position as a leading building EPC company in its segments of operations. With the healthy order book and sustained order inflow and our expertise in executing and delivering projects on time, we are optimistic that we shall witness a healthy and sustainable growth. We will continue to expand our reach, invest in our talent pool, and unlock efficiencies to deliver a robust performance year after year. Certain key updates. The company has been awarded projects worth 3,462 crores excluding GSTs in FY23. Most importantly, the company recovered 28 crores in cash and 24 crores in property via the NCLT route against slow-moving debtors over and above the normal collection during the last quarter. I now turn to performance highlights for Q4 FY23. Revenue from operations for Q4 FY23 grew by 27% to 439 crores as compared to 347 crores in Q4 FY22. The EBIT for Q4 FY23 grew by 77% to 58 crores as compared to 33 crores in Q4 FY22. The PBT for Q4 FY23 grew by 131% to 36 crores as compared to 16 crores for the corresponding period last year. PBT margin for Q4 23 stood at 8.3% as compared to 4.5% in Q4 FY22. EBITDA for Q4 FY23 grew by 46% to 85 crores as compared to 58 crores in Q4 FY22. EBITDA margin stood at 19.4% in Q4 FY23 as compared to 16.7% in Q4 FY22. PAT for the quarter FY23 grew by 88% to 21 crores as compared to 11 crores in Q4 FY22. PAT margin for Q4 FY23 stood at 4.8% as compared to 3.2% in Q4 FY22. Performance highlights for the full year ended FY23. Revenue from operations for FY23 grew by 34% to 1791 crores as compared to 1340 crores in FY22. EBITDA for FY23 grew by 56% to 360 crores as compared to 232 crores in FY22. EBITDA margin for FY23 stood at 20% as compared to 17.1% in FY22. EBIT for FY23 grew by 69% to 224 crores as compared to 133 crores in FY22. EBIT margin for FY23 stood at 12.4% as compared to 9.8% in FY22. PBT for FY23 grew by 105% to 135 crores as compared to 66 crores in FY22. PBT margin for FY23 stood at 7.5% as compared to 4.9% in FY22. PAT for FY23 grew by 95% to 94 crores as compared to 48 crores in FY22. PAT margin for the financial year 23 stood at 5.2% as compared to 3.6% in FY22. The gross debt stood at 366 crores with gross debt to equity at 0.34, while the net debt stood at 183 crores with net debt to equity ratio at 0.17. The working capital cycle excluding retention stood at 117 days in March 22 and improved to 105 days in March 23. We are focused towards meaningful reduction in working capital during the current financial year. The company continued its focus on increasing execution across projects. The order book on standalone basis stands at 9513 crores as of March 31st, 23. Public sector accounts for 70%, while private sector accounts for 30% of the total order book. We now open the floor for thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Hi, good afternoon, sir, and congratulations on a very good set of numbers. So my first question is on the, of course, we have touched the 450 crore odd number per quarter for the revenues in FY23. How do you see FY24 and 25 based on the current order book? Do you think more than 500 crore is possible per quarter in the near term?
Yeah, hi. I think your question was pertaining to revenue for the next 2 financial years.
Yes.
So given the current order book, the company has to grow by 18 to 20% year on year. The second part of the question was in absolute terms. So a quarterly prediction cannot be given, but on the whole year, the company is confident in growing between 18 to 20% from the base of FY23 and further 18 to 20% from the base of FY24.
The second question is on the order inflow outlook. How does it looking like given the bidding pipeline as of now?
So as a policy, the company over the last 2 years has been trying to take orders to the extent of the revenue. However, the last financial year was exceptionally good. As against the target of 2,000 plus crores, we did something close to 3,500 crores. The current year 20% growth target means that we have to book somewhere in close to 2,200 crores of fresh order book. However, given the current bid pipeline, we believe that we should be easily able to surpass that. Now, bid pipeline comes from both private sector and government sector. Private sector, we will be focusing on our existing clientele. We have added DLF and Adani over the last financial year. However, we do not intend adding any new private sector client in the current financial year. So we will be looking at repeat orders from the existing clients. The government bid pipeline, both in housing and medical, is very strong. As I speak, we continue to bid. However, given the current order book and the revenue target, we have an opportunity to be choosy about the orders which we intake. one thing is clear that any order inflow has to be accredited to the margins which the company is making, and that is something which the company will be focused on.
Okay, the third question on Adani. Since Adani, does it open up the opportunities for you for Dhara redevelopment at some point of time?
We believe that we are doing a good job for the client. However, whether it opens up avenue or not, it's very difficult to say at this moment in time, because that's something which the sales-based buildings will come up at a stage. So I'm not aware whether it will be appropriate for me to comment on client-specific strategy. However, across our clientele in the private sector, all the clients are doing very well, and there will be an opportunity which will present itself across the clientele which we are working with. So no specific for Adani, but yes, if we get an opportunity, we will definitely weigh that up.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. We have our next question from the line of Parvez Qazi from Nuvama Group. Please go ahead.
Yeah, good afternoon, and thanks for taking my question. So couple of questions from my side. First, at a overall company level, while obviously order intake has been very good, our execution going ahead would obviously depend upon how we manage the working capital cycle and the liquidity. You did mention that you were able to get some amount through NCLT. How do we see one, our working capital cycle going ahead, and second, both our fund and non-fund based liquidity from the banking system in FY24? Thank you.
Yeah, hi. Let's come to the working capital cycle. The overall reduction has been approximately 12 to 13 days in the last 1 year. It has been not to our expectation. We expected better. However, that 12-day increase from December to March should not be read into. We do believe that there is a scope of reduction of 20 days over the next 4 quarters, which will release a lot of working capital. That's number one. On the non-fund based side of limits, we have already tied up 150 crores, and we expect to tie up another 250 crores or thereabouts by Q2 of the current financial year. That should take care of our bank guarantee requirements for the whole financial year. So the company will be cautious on the working capital cycle, and obviously non-fund based limits is a lifeline of any construction company. Partially has been tied up. The balance tie-up we expect to complete before September of the current financial year.
I'm sorry, I missed the number. You said additional 200 crore or 250 crore?
250 crores. Additional 250 crores on the higher side. Non-fund based limits, sir. Non-fund based.
Yeah. The next question are on the status of the MADA and the SIDCO orders. Where do things stand today, and what kind of execution can we foresee on them in FY24?
So MADA, during the last quarter, as I had informed, 8 buildings were handed over. 8 buildings amounted to about 1,500 crores of execution at the SPV level, that is Tata Projects Capacit'e Infra joint venture. Additional 6 buildings have been handed over in the current quarter, that is the first quarter of the current financial year. So therefore, out of the total 33 rehab buildings, totaling to about 5,000 crore, we have received just little under 50% of the entire scope. Of this, 35% has been subcontracted by the JV to Capacit'e Infraprojects Limited. So we do believe that close to 200 crores or 225 crores will be the revenue in the current financial year at the site, at the current project of MADA. SPV level, obviously the revenue will be close to 550-600 crores, which I had guided earlier also. However, we shall not be taking that red books. We will be only recognizing the margin to the extent of 35% on our standalone financials. Secondly, SIDCO location number 7 has already been handed over. The environmental clearance, which was the responsibility of the client, came in 15 days ago. The site leveling is currently under progress, and therefore we should see the location 7 revenue also positively kick in from Q2 of the current financial year. And therefore, we are confident that from Q2 onwards, the company will be grossing close to 45 to 50 crores of revenue per month from CIDCO project alone. Hope to have answered your question.
Sure. And lastly, let's say by the end of FY24, what kind of debt levels do you expect in the company?
So the repayment of in the current year of the term loans is close to 42 crores. So you should expect a reduction of 42 crores minimum on the fund-based limits of the company.
Thanks. That's it from my side, and all the best of you, sir.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone now. We have our next question from the line of Faisal Hawa from HG Hawa and Company. Please go ahead.
Hello. Sir, we were told that now from now onwards, the EBITDA will be around 20%. But even in this quarter, the EBITDA has not reached the mark, and even the revenue, we could have done much better with, because there are no monsoons, and the seasons are much more favorable. So why are we not able to really, break through on the revenue, and what is the revenue we are now targeting for FY23-24?
Yeah, hi. So first of all, the EBITDA for the full financial year is 20%. We guided for the full year. I request, sir, that this quarterly plus 0.5% up, down should not be read into too much. After all, the projections are for 12 consecutive quarters. So if I am giving you something during September, you can monitor that from 1st of October to 30th of September in the 12-month period, and then whatever projections I am giving, you will be satisfied or maybe even happy. That's number one. Number two, the total guidance for revenue for the full financial year was 1,800 crores. On a consolidated basis, only revenue from operation has stood at 1,792 crores, and this is after 2 of the major projects in private sector, one from Oberoi and one from state creators, being executed on contracts without concrete and steel. If I would add that value, I repeat, then the revenue would be close to 2,100 crores or so. However, that does not make logical sense because it disturbs the cash flow of the company. There is no need to invest in just to shore up your revenue. However, having said that, the guidance for the full year has been maintained, and we expect, as I just mentioned in my earlier answer also, that the revenue guidance is 18 to 20% on the base of 1,791 crores for the next financial year, and also subsequently 18 to 20% on the base of FY22. So FY25, the company will grow at 18 to 20% of the revenue of FY24.
And so where do we stand on 3 financial parameters? One is that how much has our asset turn improved? That's one. Second is what is really stopping us from getting into these metro contracts, or where you did say that we are looking at some traction, and is it because they're very good for us? And third is, sir, what is the kind of impediments that we are facing into getting these bank guarantees faster, and how are we placed on improving our credit rating from these agencies?
So if I may break down your question, you spoke about asset turn, you spoke about metro works, you spoke about bank guarantee, and you spoke about credit rating. Am I right?
Yes.
Yeah. So if you see that our asset turn last year was 3.06 times, the asset turn has improved to 4.23 on FY23, and we expect that to improve to 4.75 or thereabouts during FY24. Number 2, we are already doing railway stations, and we have completed successfully railway stations for MMRDA. However, we do not do core infra for metro works, and that is our business profile. The company is a building construction company and specializes in construction of super high rises. Obviously, the margins, you compare us or our peers with those of surface transport, you will find the margins at an industry level much better. And if you compare at EBIT level also, it would be much better than surface transport companies. Maybe one or two can be an exception. And therefore, we would like to continue our focus on our existing business, especially when the order book is close to 10,000. Third, the bank guarantee, as we had earlier also informed during quarter 3. During quarter 4, we have tied up 150 crores of bank guarantees from our existing consortium leader, State Bank of India, and we will be tying up another 250 crores before September end, and that is the total requirement for the whole financial year. These bank guarantees have to be issued in tranches. Already we have utilized and issued bank guarantees worth 50 crores in quarter 4, and therefore you have seen an uptick in the collection at 441 crores during Q4 FY23. Last point is on credit rating. This credit rating was downgraded on the basis that the financial tie-up was pending. Since the financial tie-up has been given by State Bank of India, which was already published on the stock exchanges, we are now approaching them along with our financials of FY23, and we are very hopeful that by Q2 current financial year, the company should be re-rated back to glory. Hope to have answered your questions, please.
Thank you so much, sir.
Thank you. We have our next question from the line of Yash Dantewadia from Dante Equity Research. Please go ahead.
Hi, am I audible?
Yes, please, go ahead.
Yeah, congratulations on a very good set of numbers. I just wanted to understand the margin profile. Obviously you construct for government projects and private companies. So can I understand what is the margin difference when you're working for government projects and you're working for the private player?
So Yash, the point is that the company is a specialized super high-rise and high-rise construction company. Obviously, the EBITDA margins are always higher in super high-rise. Given the execution expertise required, and also to some extent the high CapEx required for construction of super high-rises. All right. However, for construction of normal buildings like 22 story, which are in shell and core, you will have EBITDAs of 11 to 12%. However, the company is not engaged in construction of such projects. Coming to the government sector, the margins profiles are a little bit better. I had explained this during my last conference call also, simply because they are all on EPC basis. EPC includes the E word, which means engineering. Engineering is not done in the private sector. Engineering is done by the client. In government projects, the engineering is done by the construction company. And therefore, the company has an opportunity to improve upon the engineering and therefore save costs. Saving of costs means improved parameters on profitability, whether PAT, PBT or EBITDA. So summing up the question, the margin profile in private sector is about 200 basis points lower than the government sector, and that is attributable to the engineering part which bigger construction companies are now engaged in.
And could you give me an idea of the working capital days difference in the private and the government sector? Is there a very large difference?
There is no difference. The net working capital has been higher there has been some reduction due to recovery of slow debtors collections. These slow debtor collections we expect to continue in the current financial year, and therefore we have given a guidance of close to 85 days as net working capital excluding retention by the end of FY24.
Also, sir, one more question I had was regarding your OPMs. This year you clocked approximately 20%, which is basically a historical high for your company, right? I think your last high was 18% in 2017. So what I want to really understand is this sustainable? I mean, you've already answered that, and you said there's a guidance of 18 to 20% going ahead. But I just wanted to understand how sustainable is this, if you think about this company from a 5-year profile.
See, first of all, we have started giving a guidance on the EBIT level, which has improved significantly at 12.5%. We expect that to be a sustainable figure over the next foreseeable future, 3 to 4 years. Now, the EBITDA is not comparable to other in industry because of our high depreciation cost. And having moved from output method to input method, the depreciation, the site establishment and temporary structures which were being carried in the balance sheet at 227 crores as on 31st March 2022 have significantly fallen to 150 crores in the current as on 31st March 23. This reduction, as I earlier guided, over the next 6 to 8 quarters will be totally written off. And then though there will be no impact on the cash flow of the company, because these expenses have already been carried out in the past. So going forward, I would suggest that investors keep an eye on EBIT. The EBITDA guidance is on the basis, the EBIT and EBITDA guidance is on the basis of the existing order book, profitability of which is already determined. Secondly, we have a pass-through mechanism for all the ongoing projects, and therefore it is not speculative in nature. Therefore, the consumption pattern has been very, very similar if you see over the last 4 or 5 years. The reduction in percentage is because of the improvement in profitability due to the engineering side of the business.
Sir, also this year, what was the total order win, and can you give me the mix of public and private order win?
The total order inflow, excluding GST, stood at 3,462 crores in FY23.
Okay. Could you write the
in front of me? But in this 3,562 crores, it would be 50% in private and 50% in public. However, on the overall order backlog of 9,500 crores, 20% public sector and 30% private sector.
Thank you. I'll just come back in the queue. Thank you so much.
Thank you.
We have our next question from the line of Khushbu Gandhi from Yes Securities. Please go ahead.
Yeah, sir. Thank you for giving me the opportunity. A few questions from my side.
Yeah.
Firstly, for FY24 revenue guidance, since you have given us a good growth guidance of 18 to 20%, can you just highlight which all projects would be majorly contributing to it?
Madam, all the 14, 15 top projects would be contributing nearly 92% to the top line. However, it would take a lot of time going through each project. You may kindly send a mail and our IR department will immediately respond to it.
Okay, sir. Secondly, on the order bid pipeline, if you can give us an idea, what is the current orders which are bidded and yet the results are yet to be out, and what would be our bid pipeline going forward for FY24?
Ma'am, as I have already mentioned, the company will take order inflow in line with the revenue for the current financial year. So the company's target is about 2,200 crores or thereabouts for order inflow intake. Now, having said that, last year our guidance was 2,000 crores, but we did 3,400. That was specifically because we were awarded a repeat order from Raymond's, from Godrej, and alike. So we expect that momentum to continue in the current financial year. So there should not be any surprises on the positive side. But as our internal target to be informed to you, we should be at 2,200 crores. That would again translate into about 4 times our FY25 turnover target.
Okay, sir. And sir, one more question. In the current quarter, the tax rate was quite higher. Any reason why the tax rate was higher?
Madam, we have taken a one-time impact of site establishment, which was written off, and there is no tax benefit on sale of loss on sale of site establishment. Therefore, this one-time impact of 6.64 crores has dented the profitability to likewise amount of 6.64 crores. That's one time. It will not be happening in the balance future quarters. This is a permanent difference, and the tax benefit on permanent difference is not available.
Okay, sir. That's it from my side.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Hello. Good evening. Good afternoon, sir. Am I audible?
Yes. Please go ahead.
Yeah. So firstly, sir, congratulations on a great set of results and great to see company performing so well. So, sir, so we've been very clear about our revenue guidance. So I just wanted to know, EBIT we have done 12.5% this year also. So with growth in revenue, can we see some operating leverages and, with reduction in some cost or something, could we see a better margins, or how would that work is the only question that I have.
You see that all the project sites are totally manned. There may be some increase in salary costs due to increments, annual increments, and manning of the 7th location of CIDCO. Having said so, the percentage to the top line in the expenses, that is fixed cost, is expected to come down. Now, reduction in that will improve the operating margins, and therefore, definitely there is an opportunity to improve upon the operating margins, and that is directly proportional to the top line, because fixed cost as a percentage will fall. On absolute levels, they may be the same or increase slightly. However, as a percentage to top line, they may fall, which will see better operating margins. That is what my take is. However, it will pan out from quarter 2 of the current financial year.
So on, just to summarize, so on overall basis, we might see a bit better margin, maybe by, 1.5, maybe around 1% plus, because of our, growth. So that would help us, get better margins because of the leverage. So
absolutely, Mrs. Zaveri, dil mange more. But the point is that we have to see how it pans out. All right, the company has surpassed its pre-COVID levels. We are focused on our operations. We are focused on reducing the old slow-moving debtors, since the courts are moving very fast now. They were very slow over the last 2.5 years. So there are some exciting times at this moment. As I speak to you, we see completion of 2-3 projects over the next 2 quarters, which will give us an opportunity to shift our resources to newer projects, which we bag over the next 2 quarters or so. So yes, there is an opportunity to improve upon the parameters of margins, as I say, in percentage basis. But I think the company's current levels are also very desirable.
That definitely they are, sir. So, and if I may, one more question. So, any kind of hindrance or, speed bump that, we might, foresee right now, or everything's, right now just breaking in our favor? Any headwinds that, that might just impact, or anything that you could say from this perspective?
So if you see, the company has followed a very aggressive ECL policy over the last 3 years. The company has made provisions on a gross level over the last 3 years of about 135 crores or so. Now, given the size of our company and the post-ILFS issues which the whole industry saw, it was only prudent for the company to provide such big amounts. All right? And therefore, the slow-moving debtor level in the balance sheet has dropped drastically. So from that perspective, investors may relax. The company will recover its money. You will see some sort of reversals happening in the whole current financial year. Please do not ask me on quarterly basis, but for the full financial year. And therefore, I don't see any headwind. Now, if there is something which I cannot foresee today, I cannot comment on that. However, I do not see any headwind as far as our operations or for that matter scaling up is concerned. The company has to do what it knows the best, keep executing the projects at the pace it requires.
So that's great to hear. So congratulations and all the best for the next great year. Thank you so much.
Thank you. We have our next question from the line of Sandeep Rashid from Arjav Partners. Please go ahead.
Yeah, thank you. Sorry to ask you to repeat this, but just a clarification. You had mentioned working capital days. Did you say that your target was around 80 days, ex retention money?
85.
85.
So reduction of 20 days. We will try to do better, but the guidance is given at 85 days.
Thank you. And the second thing, you said that we should be looking at EBIT margins.
I lost your voice.
Voice is sounding muffled.
Can you hear better now?
Is it
better?
No, it is still muffled.
Let me try this any better. I'm speaking on the phone. I'm not on a hands-free.
Yes.
Yeah, please go on. I'll try to understand your question.
Okay, thank you. Your guidance.
I'm sorry, we lost you again.
Can you repeat your margin, please? I'm sorry for that.
Okay. What I mentioned that the investors, because every company has a separate depreciation policy.
Sure.
And write-off of temporary structures, and therefore though the cash profit does not change, but the depreciation is substantially high compared to peers or peers of our size, please. And therefore, we are suggesting that you all monitor the EBIT levels, which has shown healthy growth over the last 2-3 years. And there was another question earlier whether that is slated to improve or not. On FY22, the EBIT level was 9.91%. On the whole year, the company has done an EBIT level of 12.53%. I do believe that it is a sustainable level of EBIT for the organization. Can there be an improvement? There are opportunities, and we are working towards it. So this is what I was mentioning. I hope you have heard me loud and clear.
Loud and clear. Thank you, sir. I'm sorry to make you repeat those questions.
No issues. No issues.
Thank you.
Thank you. We have our next question from the line of Pritesh Chheda from Lucky Investment Managers. Please go ahead.
Sir, what is the total non-fund based limit that we have now, and what is the utilization?
Yeah. 1 minute, please. I have to take out the paper. Please give me half a minute.
No problem, sir. And,
yeah, go on.
The associate, so along with that, the last rating which was done by India Rating, which highlighted the little bit of liquidity issue for us. So what is the gap between their interpretation and our presentation?
Yeah, so 2 questions. The total fund-based and non-fund-based limits at the moment which the company is enjoying is 1323 plus 150 crores. So close to 1,500 crores.
1,500 crores.
All right. Out of that, about 170 crores is unutilized. Now, within this overall limit, the total term loans are 160 crores. The emergency line of credit, which was given during the COVID period, the residual value is 29 crore, and the cash credit utilization is 159 crores. The total non-fund based limit utilization is 973 crores as on 31st March. Okay.
So which means it is a 70% type utilization. The non-fund is 1500 crores, in which if you are using 1000, so it's about 2/3 utilization.
Please take it again.
Yeah, that is not mentioned, right?
If you remove the term loan from that 1500 crores,
okay,
then you have a 1340 crore working capital, including project-specific working capital.
Okay.
All right. In this, the CC limit, please remove 165 crores.
Okay.
The total non-fund based limits of bank guarantee and LC stands at 1175 crores.
In which you are utilizing 970.
Okay. In which we are utilizing at the moment, 1 minute please, 972 crores, you're right. And that gives us a gap of 203 crores. But that is on a particular date of 31st March. Maybe some LC would have been issued over the last 2 months. Some bank guarantees would have come back. New bank guarantees would have issued. So, therefore, I mentioned in the earlier question also, the company will be tying up further guarantee limits of 250 crores. Okay. To cover the whole assessment for the current financial year 23-24 as done by State Bank of India, lead bank of the company. All right. That's a part number 1. Part number 2 was that India Rating had mentioned that on 27th February or some thereabouts, that the company has not been able to tie up the non-fund based limits, resultant of which there will be cash flow issues. 5 days after that, we had given an explanation that the company has already tied up 150 crores from State Bank of India. Now, since our yearly results have been adopted, we have already started the process of submitting all the documents to them, and therefore we are confident that by Q2 of the current financial year, we should have the earlier ratings available with the company.
But sir, when you will grow next year, again there would be a need. So again, will they come back saying the same?
No. Please try to understand that the tie-up which happened in February should have happened in September last year. All right? So the delay resulted in an action. However, the tie-up has already happened as it to you. And secondly, the tie-ups are on the basis of the assessed limits. It is not for the last year's requirement. It's for the current year plus Q1 of the next financial year. It is on basis on that requirement. Else, bank guarantees keep coming back and fresh bank guarantees are issued. And therefore, I do not see a situation like February arising again.
And for getting the non-fund based limit, you would have to give FDs or some portion of your cash flow. So this bank guarantee or non-fund limit increase, which you bring in, is it for FY24 and 1 quarter of FY25?
Absolutely. So the bank guarantees are assessed by the lead bank on the basis of the existing limits and the requirement on the basis of further order wins, return of advance deducted guarantees, return of old performance guarantees, and issuance of new performance guarantees and retentions. So that is how the overall assessment has been done by the lead bank. Your point is right.
So which means that if you do not want to be in such a situation, either there has to be surplus liquidity on your balance sheet, which is a function of a better cash flow, either via working capital release or by doing lower business, whichever way, so that you don't get into this ratings issue every now and then, every 6 months. Is that the way that I have to look at it?
See, the point is the company has been doing turnover in guidance with the cash inflow. So we have improved our inflow during the Q4 to 440 crores. All right. So the collection levels have gone up by nearly 50 crores from Q3 or 60 crores from Q3 of last fiscal to in Q4 of last fiscal. We expect that momentum to continue. Number one. Number two, 150 crores of limits have been tied up thereafter, and therefore the cash flow will improve to that much level over the next 2 quarters. Next 2 quarters means something in the current quarter, balance in the next quarter, because these guarantees will be used partially for performance, which does not give the cash flow, but majorly for advances and retention, which directly give the cash flow to the company. Yes, it has to be interpreted in that manner only. However, all companies will absolutely grow on the basis of the cash inflows over a period of time.
Okay. So are we working towards more fund release or cash flow release from our balance sheet? And what are we doing on that?
That is absolutely.
Because this year you grew 20%, next year you will grow 20%. This year you managed it, let's say, but there has to be a proper effort towards reducing the working capital, which has a surplus for you, so that you don't get into this upgrade and downgrade issues every now and then.
Yeah, absolutely, your point is well taken, and therefore I just mentioned that the cash flow improvement is the only reason why you could reach a growth of 20, 25 or 35% over year on year. If you see, last year we did 1,340 crores. This year you are close to 1,800 crores. And if we have to grow at 18-19%, it is not only an effect of how much guarantees we are going to get. It is also a result of how much cash flow from advances and retention is going to come into the company. So yes, it is both guarantees which partially are available now and fully should be available by September end for the full financial year and the Q1 next year. And secondly, improved cash flow and release of A, retentions, B, improvement in debtor cycle, that is release of old. I just mentioned in my opening statements that the company has collected slow-moving debtors of 28 crores in cash in the Q4 of the last fiscal. Now these releases directly add to the working capital of the company, and therefore our sense says that over the full FY24, the company will be in a better position to collect such money because of primary 2 reasons. A, the developers do not want their properties to go away in NCLT, and therefore the people who are moving very slow earlier now are coming forth for settlements and upfront payments. All right, that's point number 1. Point number 2, we have not added any slow-moving debtors apart from what was there 2.5 years back over the last 2 years. So these 2 parameters will help the company to substantially improve the cash flow over the current year and the next financial year.
And my last question on the depreciation.
Yeah.
You mentioned there were temporary structures which you are writing down, and there is some 140, 150 crore which you'll write down further. So this depreciation number, which was taken up this year to about 140 crores, will be what number next year? It will be a same 140 crore that you will have depreciation, and then it will come down?
Absolutely.
Right? So, that's how I should interpret your comment.
That's how you should take it only. Because the point is that there is nothing being added to the site establishment. The figure which was 227 crore on our order book or in excess of 10,000 crore has come down to 150 crores as on 31st March 23. And the average write-off is close to 50 crores on that account on a yearly basis. 50 or 670, what is it? 70 crores on an average. So over the next 6 to 8 quarters, you can take a taper period of 8 quarters, the entire site establishment will taper off and become zero. And therefore the depreciation then will be comparable to the peers, which would be close to 45-50 crores.
So this 140 crore for next 2 years
absolutely
will then come down to 60-70 crores.
A little bit lower than that because the equipment additions will be lower and the depreciation will continue at the current level.
But sir, then will you have temporary structure case in some other project? Is that a future date or it's some specific project which you have?
What is temporary structure is nothing, it is site establishment. Companies following input method, they take it as a cost and comes into the WIP and written off over the project cycle. We were earlier following the output method and we have migrated into the input method. So since we have migrated into input method, the temporary structures which was following in balance sheet earlier, now no longer is required to be increased. Everything hits the P&L account directly.
Okay. Thank you.
Welcome.
Thank you. We have our next question from the line of Jiten Rushi from Axis Capital. Please go ahead.
Yeah, congratulations on good set of numbers and thank you for taking my question. So most of the questions have been answered, but sir, there is one question which I would like to ask. In the last quarter, we had discussed about the settlements which you were expecting, some cash flow from the same. So we were pursuing aggressively. So any positive on this with those settlements?
So let me just take this. It's an important question, so we have to explain in detail. And I'm thankful that you have taken up this point. So among the biggest slow-moving debtor was Radius Group, which included Radius Deserve, which included Radius D Delty, which included Radius Sumer, and so on. And including the site establishment, retentions, and WIP and certified debtors, the amount was close to 130 crores. Total exposure. 44 crores was written off as ECL. We have received 15 crores from Godrej against the takeover of project from Radius. Similar Nilkamal, which is at Mahalakshmi. So we have realized that. Apart from that, we have also realized another 16 crores. And for the entire remainder of the exposure of Radius Group, we have got properties allotted. So we are no longer financial creditors. Sorry, we are no longer operational creditors. We are financial creditors. So commercially, the entire risk of the company has been covered. And in one of the cases in Radius Deserve LLP, the court verdict has come declaring Capacit'e Infra as the flat allottees. And therefore, whoever takes over the project will have to treat us as home buyers. So this is the resultant of the 2 years of severe hard work that the company has put. And you will see such settlements adding to the company's either cash flow or either reversal in the quarters to come.
So what I understand is 16 plus 16, 32 crore has been realized, 44 crore has been written off, while for the balance there is some inventory which you have right over it, and when these people sell the project, you will have that, you can get collect your cash to those inventories.
Projects have already been sold, some are in LCLT. The idea of the company is to first secure itself commercially, all right? Because the company has been doing projects in Mumbai where the property prices are very, very high. I am sure no developer would like to send his company to NCLT for a 12-15 crore exposure to Capacit'e Infra. All right? However, we wouldn't like to take any risk on the commercial sensibility, and therefore we have obtained over a period of 2 years either agreement to sale or allotment letters backed up by stamped memorandum of understandings, apartments of 68 crores, residential premises of 68 crores, which will, going forward, add to the cash flow. However, it will totally secure the company as far as its commercial outstanding is concerned. And that is what I am trying to tell you.
So broadly, this would cover interest, or it will just cover what the commercially, anything like the interest are we going to cover, or it's just the cash flow which we have to cover as a receivables from the developer?
Sir, we have written off at the gross level 130 crores over the last 3.5 years. So if we can reverse even 60 crores, 70 crores over the next 6 to 7 or 8 quarters, the company will add that to the bottom line directly. Right. So I wouldn't like to comment on the interest component because the cases filed against those particular clients, the amount receivable or claimed is higher than the book liability. It would not be appropriate for me to disclose that. However, I can only say that commercially, we are ensured to protect the company's commercial interest against all its outstanding.
That is very good. So one last question from my side is I had missed on the MADA project. Have you given any revenue guidance in totality and probably your share of 35% for next couple of years?
Sir, I have missed your point. MADA revenue, you want the guidance or what we have done in the last year?
So last year plus going forward, I see the site has been moving very fast now. So what have you booked in FY23 and totality, and what is your share in the standalone, and probably what would you be booking in totality, and what would be your share? Obviously, your share will be 35%. So
we have certain additional scope of works also, including that scope of works. Apart from the 1,200 crore of building portion, we have certain other scope of works. Total billing is close to 90 crores in the last financial year, and we do expect to do 175 crores. That was the guidance. 200 crores in the current financial year. Hopefully, we can improve upon that, but 200 crores is given.
So this is your share, correct, sir?
This is our share. At standalone basis, as a subcontractor to AlphaProjects and Capacit'e JV.
So, sir, what is the increase in scope? As you said, there is some increase. So, what is the increase?
Sorry, sir?
So, you said something on the increase in scope for this project. So, what is the increase in terms of value and what type of work has increased?
So, there will be another 200 crores billing apart from the normal 1,200, 1,300 crore of buildings to be constructed. This will be attributable to certain parts of engineering, certain site licensing, permissions approvals, and so on and so forth. Those are very elaborate PMC requirements. So that will be taken and carried out by Capacit'e Infra as per the order received from the JV.
Okay, sir. Thank you and all the best from my side, sir. Thanks a lot.
Thank you very much.
Thank you. We have our next question from the line of Anand Shah from IFCON. Please go ahead.
Yeah, good afternoon and thanks, sir. 2 questions. One of them partly answered by you, which was regarding the higher tax expense this quarter. In case you can throw any further light going forward on how you see that normalizing, that would be good. And secondly, on the PAT margin side, so historically we've seen that to be around 6% range. Do you see that being maintained going forward, and any reason you believe that can see a higher tick in upcoming quarters? Thank you.
On the tax point, I already have clarified that it's a one-time on basically loss of sale of site establishment and other provisions where the tax benefit is not available. So that amount of 664 lakhs is one time. It will not be recurring in the future quarters, including quarter 1 of the current financial year. That's point number 1.
Sure.
The point number 2, which you said on the margins, I would like you to monitor the EBIT margins because PAT margins will vary on the depreciation claimed by the company quarter on quarter. It may also, the PAT margin will also get one time impacted where engineering and design bills are booked. The margins will also get impacted on a positive note where as and when the reversals start happening. So on the EBIT side, apart from this, gains which will come from these old provisions, old write-offs, you should expect the current profitability to be sustainable. However, guiding you on the EBIT level will be more appropriate, and the company is expected to maintain that and maybe improve. I repeat, maybe improve over the next 2-3 years as we move forward.
Right, sir. Okay. Thanks a lot. Thank you.
Thank you. We'll take our last question from the line of Yash Dantewadia from Dante Equity Research. Please go ahead.
Yeah, my last question is regarding the QIB. Could you throw some light into it? Because what kind of interest are you seeing from qualified institutional investors? And again, will it happen? Is there any probability of that happening below the book value?
It's too early. We have just taken an enabling resolution at the moment in time. The company always has to have plan B. All right. And we do not want anything coming in the way of company's growth plan in the midterm. So therefore, an enabling resolution has been taken. My assessment will be sounded out to keep you appraised as and when the developments happen. But we have just got an approval. We will go for approval of the shareholders through appropriate route as per company and SEBI guidelines. And once that is done, I'm sure you must be knowing Amit, who's heading our PR, IR. You can get in touch with him for any detailed answers or queries concerning QIP.
So just to conclude, you said this is the QIB is your second option, not your first option, right?
See, again, we have taken an enabling resolution for QIP and QIP and other mechanisms which have the same guidelines of QIP. All right? Because there are separate resolutions for QIP and separate for preferential. So at the moment, the enabling resolution is for qualified institutions only. And once we have the approval, the board approval subsequently, we will get back to you and keep you appraised at all times.
No, actually, my doubt was, you already have a 150 crore line from SBI. From what I heard before is you require 250 crore more to reach this year's revenue guidance target, right?
Sir, it's 6 years since our IPO. All right. So basically, it is every second year we take an enabling resolution. There has to be a plan B in place in case of any delay. The growth of the company cannot be compromised on. And therefore, where the resolution is up to 200 crores on whether we raise 150, 175, 150, that's anyone's guess. Whatever, and whether we raise at all or not, or we raise the entire 200 crores, that is a question which cannot be answered today. We will keep you appraised, as I said. And yes, if the bank guarantees come on the dotted line, then the requirement of QIP will be lower. And we have kept all options, as I said, option 1, option B, and option 3, all available to the company to ensure there is no impediment in the growth of the organization.
That's great to know. Thank you for being so patient and taking all my questions. It was great talking to you. Have a nice day.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Rohit Katyal for closing comments. Over to you, sir.
I would like to thank you all once again for joining us on this call today. We hope we have been able to answer to your queries. Please feel to reach out to our IR team for any clarifications or feedback. Thank you and have a nice day. Bye-bye.
Thank you. On behalf of Capacit'e Infraprojects, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.